There's something very, very sick inside the economy.
We're in the third great bull market in gold in history. That was an almost 700% gain. Exactly what Jim Rogers said would happen.
That causes deflation. There's something very, very sick inside the economy and in our monetary system to be driving gold that high. So question number one, Jim, why is the price of gold rising? What's going on in the economy?
If you have gold, you can pat yourself on the back and say, yeah, I made a lot of money on gold, but that might be in a world where you're losing a lot of money on other things, and you need to be alert to the overall economic picture. So let's take this one at a time. We're in the third great bull market in gold in history. When I say in history, you're like, well, gee, history's a long time. How come this is only the third bull market? Well, the answer is for almost all of history up until 1971, gold was money. So you didn't have bull markets or bear markets. It was just gold. That was the money. And you thought about it by weight. You say, well, I'll give you an ounce of gold for this property, or I'll give you, a quarter ounce for, some food or groceries or whatever. So you thought about gold by weight. It was money, constant store value. So it's really only since 1971 when Nixon suspended redemption of dollars for gold by our foreign trading partners, that gold just went its own way, detached from the dollar. So the dollar would do what it was going to do, and gold had its own market, and still does. The first great bull market was 1971 to 1980, and gold went up over 2,000%, from $35 an ounce to $800 an ounce in January 1980. Then there was like a long, drawn out, almost 20-year bear market from 1980 to 1999. And gold dropped down to around 250, so it went from the 800 level down to 250. The second great bull market was from 1999 to 2011. August 2011, gold went from $250 an ounce to $1,900 an ounce. That was an almost 700% gain. Then the second bear market, August 2011 to December 2015. The third bull market, I can give you the exact date, December 16th, 2015. Gold hit $1,050 an ounce. That was the bottom of the second bear market I described. Nothing goes from here to the moon without a 50% drawdown along the way. It'll get there, but it'll go up, down 50%, and then back up for the really big, sort of hyperbolic price move. We said, and you have to expect that. It's true of all commodities. Well, taking that advice, I then, looked at the charts. Well, starting 1900, if you say, okay, it was 250 was 1999, 1900 was August 2011, so there was that gain. 250 to 1900, so there was that gain of $1,650 an ounce of gain. Take half of that, that's 825. So take 1900 minus 825. And guess where you come out? You come out right at 1075. And so when I saw 1050, I said, bingo, there's the 50% drawdown. It's exactly what Jim Rogers said would happen. That's the bottom. And it's up about 50% from there. Now, it's been a little bit higher than that, but it's up about 50% from there. So there's your third bull market. But here's the point, Robert. If the first bull market was up 2,000%, and the second bull market was up 700%. If you just take the average of those two, you don't have to pick the higher of the two. You don't have to go crazy. Your sale will be bigger than ever. It could be, but you don't have to do that. If you just take the average of those two, you would come up with a number around 1,400% gain from the 1050. Well, that would put you at almost $15,000 an ounce. And by the way, don't wait. If you agree with that analysis, and there's more to back it up, don't wait until 2025. People say, oh, okay, well, it's going to be $15,000 an ounce. I'll go out and get it in 2024, I'll catch the wave. No, it's a long way between here and 1,500. I mean, you got to get to 3,000, 4,000, 5,000, 6,000, 7,000, etc. You got a long way to go to 15,000. So why not get the gold now, which I do recommend, and then enjoy all those profits. Don't wait to the end, because it could happen. There could be like a little spike at the end.
So Barrick will start buying junior miners. That's the
plan. They don't have the time to go out and explore and produce and take all that risk. They'll just wait until other people do, hit a good gold mine, prove it out, start mining, start producing, then they'll just buy that company and add it to their output. A gold mining company is a leverage bet on gold just because of the economics. You have fixed costs and variable costs. Well, once you cover your fixed costs, and assuming you can control your variable costs, as the price of gold goes up, all that money goes straight to the bottom line. Initially, you got capital costs and leasing and geological surveys and all kinds of things. But once you get producing and you cover your fixed costs, a lot of the incremental price of gold goes to the bottom line. The stock market gives you a multiple of that. So the answer is, if gold's going to go up 5 times, which I expect it will, or more, a mining stock could go up 25 or 50 times, just because of the economics of stocks versus gold.
Anyway, we're going to get into bonds versus gold, because Jim mentioned one of the most important dates in history was August 15th, 1971. That was the day that President Nixon went on the TV show Bonanza and said, hey, by the way, I'm going to steal all your money. I'm going to take the gold, the dollar off the gold standard. And after that, then bonds became better than gold, technically. You know what I mean? And so that's why so many old guys are trapped we've been in this raging bull market in bonds. And that may change if the yield curves change again and interest rates go up. So the contention has been between bondholders and gold holders. So Jim, could you mind explaining a little bit more differential between bonds and gold?
Just to be clear, when I talk about bonds, I'm talking about the U.S. government securities, U.S. Treasury securities, or I might talk about Japanese government bonds, so-called bunds, which are German government benchmark bonds, etc. I'm not really talking about corporate bonds. We could, but the problem with corporate bonds, they have the economics of bonds, but they also have all the credit risk of stocks, and they're very idiosyncratic. There's probably some good corporate bonds out there, and there's some you wouldn't touch with a 10-foot pole because they're going to go bankrupt. So I'll keep away from the corporate sector. I'm familiar with it, but that's not my area of expertise. So I'm talking about bonds. I'm really talking about U.S. Treasuries, unless I specify one of the major other global benchmark bond markets. When interest rates go down, the price of the bonds goes up. And when interest rates go up, the price of the bond goes down. And the reason for that is if you have a bond with a certain coupon and interest rates go up, a new buyer is going to want that new bond. It's going to, hey, give me that higher coupon. Well, I got this other bond over here, it's got a lower coupon. We'll say, well, you have to sell that to me at a discount because I need to get comp for the fact that it doesn't have as high an interest rate. So simple as that. Interest rates up, prices down. Interest rate down, prices up. That's how the bond market works. They're not distinguishing between real rates and nominal rates. Now, what's the difference? Nominal rates, that's the rates you see those are the rates you see on TV. You look at the screen. Right now, the 10-year Treasury note yields about 70 basis points, give or take, et cetera. And you can look at the yield and everybody. That's the nominal rate. That's the rate they pay you if you buy a new one apart. The real rate is the nominal rate minus inflation. And that's what counts. Real rates are what motivate people. If real rates are low, that's when people borrow, they'll invest, they'll start a new plant and equipment, they'll buy a house, whatever it may be. So nominal rates are low, yeah, that's certainly true, but real rates are still pretty high. They're slightly negative. For example, I said 10-year Treasury note yield to maturity right now is about 70 basis points. What's inflation? Using the Fed's preferred metric, it's about 1.6%. And so you've got a 90 basis point negative real yield. Real rates are negative 90 basis points, not even 1%.
So that means you're losing money.
You're losing money, but that's still a very high rate in a weak economy.
A negative interest rate means if I put money in a bank, I get less money back over time.
Correct. You put $100,000 in the bank, you go away for a year, and you come back, and your account says $99,000.
So what I'm asking you is this: when I was this young kid, I never understood bonds. I understand debt.
Right.
Because I'm a real estate guy, and the interest rates went down. I got happier as Larry. We could buy more real estate, and I never understood why would I put my money in a bond. But I understood gold because nobody could mess with it. There was no counterparty risk to it. It was just gold.
Well, when you're borrowing money for real estate, in effect, you're issuing bonds because somebody's taking the Kiyosaki note. He's the bondholder, but
yes. I issue bonds.
Many years that you want to be in the real estate side of that. You want to be the borrower, not the investor.
That's correct.
Not the bond investor, right?
And so I'm ignorant when it came to bonds. That was a whole thing. But now Jim and I have a lot of gold and a lot of silver, just because we saved money in gold and silver. We just kept using debt to get rich.
Sure. Well, you kept issuing debt, but now we're talking about buying debt.
Correct.
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 And for the investor, for someone with money, absolutely have your gold and silver, but I'd have some treasury notes side by side because they're set up for very large capital gains because interest rates are going to go even lower. And when people say they can't go lower, my answer is, just watch because Germany has negative rates, Japan has negative rates, the U.S. still has positive rates. Rates could go a lot lower.
So the final question to you is when I buy gold and silver, the velocity stops?
Yeah, because I'll speak for myself. You buy gold, you put it in a vault, and you sit on it. Well, I'm not spending the money.
That causes deflation.
Correct, and that's why Franklin Delano Roosevelt confiscated the gold
and changed the price of gold
before he raised the price because it was the ultimate insider trade.